is Mark McLaughlin, and I'd like to talk to you today about business tax deductions and a specific deduction for wages paid by a self-employed individual or a partnership to the individual's spouse or civil partner. And I'd like to refer to a recent first-tier tribunal case regarding wife's wages. Now, in this talk, I'm going to be referring to wife's wages, but of course it could refer to wages paid to any spouse or civil partner. In the 32 years or so that I've been a tax advisor, I've seen many claims for wife's wages in the accounts. A lot of these seem to have been on a routine or arbitrary basis. However, it needs to get over the wholly and exclusively rule in order to get a tax deduction. And in addition to that, case law has established that 3 criteria must normally be met for wife's wages to be allowed, and this applies equally to family members. These cases cover family members in general. First of all, the payment or the wife's wages must be realistic and not excessive. Secondly, the payment must be recorded in the books and records of the self-employed individual. And thirdly, it must actually be physically paid. The wages must be physically paid. In addition to those 3 criteria, there is also a rule for tax purposes that if you're providing for wife's wages in the accounts, then the payment must be made within 9 months of the end of the period that you want the deduction for. If it's any later than that, then the deduction will be deferred until when the payment is actually made. Now, I mentioned the wholly and exclusively rule earlier. A deduction can be wholly or partly disallowed depending on whether the deduction is considered to be excessive or not. But there is a pitfall here in as far as, although a deduction may be denied or restricted, as far as the recipient's concerned, it will still be taxed in full. So it may be subject to tax and national insurance, even though at the other end a deduction is restricted or denied. I mentioned at the start of this talk a recent first-tier tribunal case. That case was McAdam versus Revenue and Customs. This case concerned a heating and plumbing engineer who claimed wife's wages in the accounts. His wife was responsible for admin and accounting duties, and I think in the accounts he claimed a deduction of £90 per week for wife's wages. The Revenue opened an inquiry into the accounts, and one of the things that they looked at was wife's wages. They asked about the duties that the wife performed for the business, and they did their own calculations, and they worked out that at an hourly rate of, I think it was £8 an hour, that the deduction actually due was only £1,344 for the whole year, so there was a part disallowance in those circumstances. So I think that the key point to take away from all this is evidence is key. First of all, that the work has actually been done and what work has been done. And secondly, evidence that the payment is actually at a commercial rate and is not excessive in relation to the work undertaken. That's all I have to say on this subject. Hope you found it interesting. My name is Mark McLaughlin. Thanks for listening.